Everyone, and welcome to the 2022 market forecast presentation. My name is Kyle Berg, and I am a financial planner at Affiance Financial and will be your moderator for tonight's presentation. With me tonight is Marc Usem, who is our Chief Investment Officer, the Chair of our Investment Committee, along with a financial planner and Director of Trading. Before I bring Marc on, I do have a couple housekeeping items I want to make sure everyone attending is aware of. If you are interested in taking notes during this event or having a copy of the slides, they are available to download if you are joining by computer in the chat feature down below. We have enabled closed captioning for this event. However, you are able to disable it. All you have to do is click the live transcript button on the bottom of your Zoom window to disable it if you would like. If you are wanting to refer back to this event, a recording of this presentation will be emailed out afterwards, along with it being posted on our blog. Your opportunity for interaction will be different today. Instead of typing your questions, we will be utilizing an interactive event tool called Slido towards the end of our presentation. And if you would like to participate, have your cell phones and tablets ready. During that time, you as an audience will be able to choose what we discuss next. Finally, we have some important disclosures we need to read before we begin. Please remember, there are no assurances that the content made reference to directly or indirectly in this webinar will be profitable or suitable for your individual situation or prove successful. Due to various factors, including changing conditions and/or applicable laws, the content is only reflective of current opinions or positions and is subject to change at any time without notice. Moreover, you should not assume that any discussion or information contained in the webinar serves as the receipt of or as substitute for personalized investment advice from Affiance Financial. Please remember to contact Affiance Financial if there are any changes in your personal financial situation or investment objectives. A copy of Affiance Financial's current written disclosure brochure discussing our services and fees continues to remain available upon request. And with that, all that said, Marc, take it away.
Thanks, Kyle. Thanks for that introduction, and welcome everybody to our 2022 market forecast presentation tonight. We appreciate your being here and participating. We'll jump into our agenda. We'll start off by reviewing how did we get here. Let's look back at 2021, where we are now as of February 2022. What do we expect in 2022 and beyond? And of course, again, we're going to ask for your participation to choose some of the topics that we'll dive into later. We like to start off with the predictions disclaimer, another disclaimer, but these are kind of fun quotes. Peter Bernstein, who was editor of the Financial Analyst Journal, and he said, "Forecasts create the mirage that the future is knowable." We always do our best to incorporate all the information we have to make our predictions about the future, but we take great humility in this process and know that our ability to do that is obviously limited. If we could know the future, we probably wouldn't be here right now. But let's jump into some of the information. Every year we kind of have an investment focus, and I think it's kind of interesting to look at where we were last year at about the same time and where we are today. And Kyle, maybe you can jump in and help me with this.
Yeah. Last year, 2021, COVID infection rates were peaking.
And now we're, I think, hopefully on the backside of several waves later of the most recent Omicron virus. I don't think last year we would have ever conceived that we'd be sitting here today with wave after wave of viruses.
No, you wouldn't. And I think with all that, vaccine deployment started as well in 2021.
And look how far we've come in the past year. It's just amazing, with almost 65% of people in the US vaccinated and almost 30% with boosters. Minnesota, we're at, I think, like 50%. We're doing even better here.
And the economic growth, I mean, who would have thought that with all the shutdowns and everything in 2020 and going into 2021, that we'd have the kind of economic growth that we had?
Yeah, really, really a tremendous year. Super strong economic growth, record growth in 2021, and sitting here at the beginning of 22 with hopefully more of that ahead.
Yeah. And we also had the stimmies, as some people were calling them. Fed and Congress, the stimulus program continued along the way.
Right, exactly. Lots of stimulus in 2020 and 2021. That is now winding down, and we expect to start reversing here shortly. We'll talk more about that.
Yeah. And I mean, obviously the election happened in 2020, but that election's behind us, but we still have obviously the politics that are still going on today.
Exactly. Politics are raucous. I mean, the divides probably haven't never been wider, although I think we say that all the time. But midterm elections are coming up. We'll see how that goes.
Something new that we haven't seen in a very long time. Actually, we have low inflation right now. So that's great. Or in 2020, we did 2021.
Right. We started the year with hardly any inflation, but now we have inflation, and that's really new in 2021 and where we are today. So that was a huge difference from a year ago.
And then finally, I mean, our clients saw it. A lot of people saw it out there. Strong stock and bond markets, good returns throughout last year.
Markets were really strong, better for stocks than for bonds, but still, an incredibly strong year for stocks in particular. So that's kind of a recap, good comparison of where we were and where we are. Let's jump into a little more detail. So last year was a tremendous year for US stocks in particular, up almost 29%, powered really by extremely strong earnings, right? So this wasn't just a valuation increase, it was really due to strong fundamentals as all that stimulus money worked its way through the economy. Bonds did not have a great year, down 1.8% as interest rates rose during the year, kind of bounced around, but rose from the beginning of the year through the end. So those interest rates pushed bond prices down and wasn't enough to overcome the already really low rates that we started at. So bonds had a slightly down year. If we look more broadly across markets, though, we see again, US at the top, almost 29%, followed by global markets, called the ACWI, All Cap World Index, up 18.7%. International stocks, international developed, up 11.4%. So good year still for international stocks, but nowhere near what we saw here in the US. We saw bonds again down 1.8%. And I think the big surprise here to most of us is that emerging markets were down last year. Emerging markets had a great year in 2020 and started 2021 off strongly. You can see early part of the year, emerging markets was leading coming into the year. And then they came unhinged as China really cracked down on a lot of their technology companies and the real estate woes. And that really caused emerging markets to fall. And China is the largest component in the emerging market indexes. What happened to interest rates? Well, interest rates did move higher during the year. Again, you can see it bounced around, but from the early part of the year, rates were just shy of 1% on the 10-year Treasury, spiked early in the year as there were inflation fears that then ebbed toward the middle of the year and then gradually worked its way back up to about 1.5% at year end. So about 0.5%, a little more total increase in Treasury rates during the year, and that does push bond prices down. And when bond yields are starting at 1.5%, doesn't take much to push those into negative territory. So backing up a little bit to what's really going on here. Well, the $10 trillion economic experiment worked. It did, right? So we had government stimulus that avoided broad economic failure after the COVID-induced shutdowns in 2020. They plugged the hole, basically. We had a short 2-month recession in March and April of 2020, shortest on record. So again, this experiment really worked. We didn't have the kind of fallout that we could have had. What did they do? Well, we know extensive array of government stimulus measures, sending out money. People actually got checks in the mail. There were PPP loans, additional unemployment insurance, And then on the Fed side, the monetary policy was dramatic as well. Low interest rates back down to almost zero on Fed funds rates, and really significant quantitative easing that kept interest rates low and markets liquid. Of course, there was an extensive push for COVID vaccination, rolling mask mandates, selected closures, all of this really designed to prevent hospitalization and death. It wasn't really to make sure you didn't get COVID, although that was good too. It was really to help our healthcare system from collapsing, which again, it largely did, and to keep our economy functioning. So what was the impact? We talked about the vaccinations, 2/3 vaccinated, over a quarter boosted, really strong economic growth in corporate earnings. Unemployment is back to pre-pandemic levels with tight labor markets. We're seeing some wage inflation. Of course, there's some side effects too, right? Record government deficits and Fed balance sheet conditions. And the stimulus and pent-up demand have created some problems. Supply chain disruptions have led to inflation in goods and services. These are the things we're going to focus on here. We're going to go into some depth on these impacts. Where are we now in February 2022? Well, here's some data that shows the waves of the COVID virus. The early ones back in 2020, we thought, wow, this is crazy. All these people are getting infected, and it certainly was. But then we had the wave of Delta, and then the Omicron, which happened so quickly and was such a huge number of people that unfortunately got sick, but has really come down very, very quickly. To put it in perspective, though, 76 million cases in the U.S., 900,000 deaths. It's a big deal. This is the number one issue that has been impacting the economy for the past 2 years. In the world, 391 million cases. These are the ones that we know about, right? So there's probably a lot more, and 5.7 million deaths. So it's a big deal. Hopefully, we're on the backside of this process. Where did it leave GDP? Well, we can see prior to the pandemic, GDP running 2 to 3% a year. This has been pretty consistent in this range, and then fell off dramatically, down 31% in the second quarter of 2020. That was a record. We've never had the government just close and shut down. Of course, it then reopened, and it shot up to a record 33.8% increase. Again, never seen anything like this before in history. And as the stimulus works its way through the economy, you can see that the last year was very strong, running 4, 5, 6% a quarter. And for the full year, we had GDP growth of 5.7%, the highest since 1984. So really significant growth in GDP. This is also reflected in corporate earnings, right? Corporate earnings, again, moving along nicely prior to the pandemic. We get to the pandemic and it falls off the cliff from $157 per share for the S&P 500 to $122, down over 20%. Popped again last year to a record up over 60% to $204 a share. Of course, the final numbers aren't in, but really significant economic growth due to all this stimulus. And we think that it probably continues somewhat, but at a more measured pace going forward. So again, stimulus reflected in corporate earnings as well. How about profit margins? Okay, so it wasn't just that there was more of everything, but there was more of everything. Profit margins reflected that as well. Very strong. I think one of the interesting things about this chart is, sure, there's downturns. You can see the dot-com crash here, 08, 09, great financial crisis. Certainly they turned down, but the trend is pretty clear. The trend over time is that corporate margins, profit margins have been increasing. And some of the reasons are that we've had a transformation in our economy from a more manufacturing-based, even service to some extent, to a much more tech-based economy where software and services have much higher margins than we had in manufacturing. And that's reflected somewhat here. So we've pulled away a little bit from what's happening on the ground to a higher level of what's happening sort of broadly in the economy today. And this shows high frequency data, daily, weekly indicators that show the economy is still really strong. Now, the pop is probably overpronounced, but we're still running at a index level of 5, well above where the economy was running prior to the pandemic. So still indicators show economy is very strong, and it's reflected in the unemployment rate. We're now near historic lows for unemployment again. The job market is extremely strong. Pandemic, I say distortion, really put us at that 14, almost 15% unemployment rate. That was a record again, and fell really, really rapidly. We're back down to a 4% unemployment rate, very close to where we were pre-pandemic. So reflects a very strong job market. But we've heard about great resignation. People are retiring or quitting jobs. And it's true. It is true. And the data shows that. Certainly people have quit jobs before. It's not a big surprise, but it's run at much lower rates. And it's really spiked here in the last year or so. There are reasons for that, including what happened with COVID, as well as COVID's accelerated some things like portability. And people can work in different places. And so that mobility has created some opportunities for people to do different things. Diving a little more into the numbers, you can see the red line is unemployment level, and that reflects what we just saw in percentages, and job openings, which is the blue line. And they've crossed before, but it's been a while. They were crossed before the pandemic back here, meaning that there were actually more job openings than people that were unemployed looking for work. And now it's happened here, but that gap's even wider. So we can see there is a supply-demand imbalance in the labor market today. There are more jobs available than people right now. It's reflected in average hourly earnings as well. So this shows average hourly earnings prior to the pandemic, again, running pretty consistently around that 3.5% range. Pandemic hits, numbers get distorted, and we're back to where this labor market is tight. And we can see that here in average hourly earnings running 5.5% plus. So it's reflected, right? It's happening. What else happened during this pandemic? Well, federal government spending increased. Now, government spending isn't necessarily a bad thing in and of itself. It's actually part of GDP, right? The formula C plus I plus G plus X, consumer spending plus investment plus government spending plus net exports is your GDP. So government spending does actually add directly to GDP. So total public debt is currently 28 trillion in the United States, big number. And you can see it spiked after the pandemic, the shutdowns and the government stimulus, but it started to come down as the economy is recovering. It's at 122%. If we look back to the great financial crisis, the stimulus that happened there, that I call it overhang from the great financial crisis, we never really got rid of that, kind of just stayed there. And then the new spike here. I do think it will moderate. And some of the questions I've heard are, what does that mean? Is that bad? Is that good? Does it matter? Well, I think it does matter. What the absolute number that matters and at what point is hard to say. But I don't think it's a crisis by any means. Japan runs at 200%. The EU about 89%. China, we don't really know. So I'd say it's high, but it's not something that we're super concerned about from a long-term perspective today. Similarly, the Fed expanded their balance sheet as part of the stimulus, and pretty significantly, right? Their goals are maximum unemployment and price stability. Those are their focus areas. And you can see this expansion of the balance sheet at the pandemic and then continuing. Almost $5 trillion went onto their balance sheet. That means they're buying treasury bonds and mortgage-backed securities. As they do that, it helps with liquidity in the markets, keeps markets functioning well. It also helps to keep interest rates low. So those two things work in conjunction. I think it's interesting to look back to 2008 when we saw the Fed take action, we thought, wow, this is a big deal, which it was, but we were running at about a $500 million balance sheet, and they added almost $1.3 trillion. At that time, I think we made a joke that $1 billion here, $1 billion there starts to add up. Now we're at $1 trillion here, $1 trillion there, it starts to add up. So we've kind of gone up an order of magnitude. The Fed has said they are going to start to wind down this quantitative easing in March, and most likely raise interest rates as well. And the effect of that is essentially will put some upward pressure on interest rates. Looking at the consumer, we see the personal savings rate and consumer debt. Pent-up demand led to the 2021 spending spree, as well as, of course, the stimulus. So things were running, again, pretty evenly prior to going into the pandemic period, the shutdown of the government. And then personal savings rates spiked, right? 33.8%, highest in history, because people had all this extra money and, in fact, nowhere to spend it. Everything was closed. So what did they do? Well, the red line shows consumer debt as a percentage of disposable income. And guess what? People paid down debt. There was nothing else to do. So that was a good thing. I think some of the bouncing around here is due to the uneven opening and things that took place, as well as the different waves of the virus, opening and closing. But what's happened is all of this pent-up demand has started to get spent. And as it got spent, it's almost back down to where it was pre-pandemic. At the same time, we see that consumer debt, while it fell a lot back in 2021, has started to rise again. My guess is these things go back to likely where they were prior to the pandemic, and that a lot of this pent-up demand was spent in 2021. And that is a big reason we saw the demand, the GDP growth, and some of the inflation that we've seen as well. So we talked about the Fed's balance sheet. Let's talk about interest rates. So that's another thing the Fed can influence, particularly on the short end, the Fed funds rate. And it shows historically what they've done when there's a recession. Going back to 2000, dot-com bubble, they cut rates significantly by over 5%. They did it again in the great financial crisis, started at a little bit lower level, all the way down to zero, sat at zero for over 6 years. Started to normalize, if you will, monetary policy going into 2018, 2019. They got it up to 2.5% before they started to cut again. And then, of course, the pandemic hit and they took it back to zero. So it's interesting. If you look at history, at least, rates are still extremely low. And the Fed doesn't have a lot of room to move right now, right? So we know that prior we had rates around that 5-6% rate. They didn't get there after 2008, 2009. How far they're going to be able to go this time to sort of reload, if you will, so they have room to cut again in the future, we'll have to see. So let's talk a little more about inflation. I think that's a headline that everybody's heard in the news. Kyle, maybe you can chime in and just on a personal level, what have you seen from an inflation perspective?
There's been a lot of things. I think one of the big ones is I'm noticing it's costing more to fill up my car. Even though I'm not driving a lot, I'm still having to fill it up and it's costing me a little bit more. I was one of the lucky few that was able to buy a car during the pandemic before kind of inventory went crazy. And then I've also noticed, even though a lot of the grocery stores have been kind of picked over, just even the food prices, especially meat, have been a lot higher than they've been in the past.
So you're seeing it firsthand. I think that's probably a good representation of what a lot of us are seeing. And I think it's important to note that it is broad-based inflation. If you go back here to the late 1990s, you can see the consumer price index, which is the red line, and the core CPI, consumer price index, which excludes the more volatile food and energy prices. And so when they're kind of synchronized like they were back in the 90s, inflation is broad-based. Now, energy bounced around a lot through the 2000s, 2008, 2009, certainly energy was bouncing around. But here again, we're sitting at 2021, 2022 with both core and headline inflation, if you will, moving higher. That broad-based inflation means it's really impacting everything. Let's dive into some of the specifics. So, what's really driving this? Energy, certainly. I mean, Kyle, you said it, filling up the car. We know that oil prices are high. That's a huge piece of what's driven CPI this year. But even stripping that out, we go into used cars and trucks, as well as new cars, which we know have had significant increases, and there's some reasons for that. And then going to the grocery store, meats, poultry, fish, and eggs. I mean, this is a big increase, over 10%. But you see it across all the categories too: apparel, shelter, medical services, and even airline fares. So pretty consistent increases with some really outsized ones as well. I think, one of the aspects of inflation that we know exists is this issue of self-correcting, right? We know there's a lot of problems out there, including supply chain issues. Supply chain issues remain a problem. This is a chart that shows the time it takes to ship goods from China to the US was at 40 days prior to the pandemic, is now almost double that. And these numbers probably are conservative, meaning we're probably longer than 73 days on the water today. So just getting goods here has been more difficult. We know there's ships anchored in the harbor. We have problems getting ships unloaded, 80 to 100 ships waiting to unload at Los Angeles and Long Beach. Before the pandemic, there were 0 waiting. So we had this backup where, because of the shutdowns in China, particularly, and in the US, they didn't happen at the same time. China was first, right? So all the containers were here, and they didn't go back to China. Then China opened up and we were closed, and they couldn't get the containers back. And so all these things kind of happened in a strange way that helped to create some of the bottlenecks that we're seeing. Now, the government stepping in, the ports are largely controlled by unions, so they have very specific rules that they can work under. And so the Biden administration in particular has gone in and tried to open up some of those constraints, get ports to stay open 24 hours, and get more people to work there. So we're in this, I call, perfect conditions for Fed policy normalization. The Fed said they're going to raise rates at the end of March and QE. And I really like this cartoon that shows Jay Powell with the clock, 2022, time's ticking, and Ben Bernanke kind of above him in the cloud saying, you got to go, it's time, you got to do it. Because of course, after the great financial crisis, they kept rates at 0 for a really long time. So why is it a good time, a perfect time for policy normalization? We showed strong GDP growth and corporate profits, low unemployment, high inflation, certainly relative to history of anything that we're used to. No stimulus mismatch, meaning the Fed and Washington aren't doing two different things, one trying to stimulate and one not. We're pretty aligned right now. And then the desire to avoid past policy mistakes. The Fed doesn't want to make mistakes that they know have taken place before. So what do we expect in 2022 and beyond? Well, first, what's ahead for markets? Higher interest rates. Fed's going to raise rates. And it shouldn't be a surprise. They're designed to slow the economy down. The economy's running hot. And so higher rates mean higher mortgage rates, auto loan rates, and other lending rates. That will dampen some of the demand in those areas. It'll create a slower rate of corporate earnings growth as it costs more to finance companies. One of the silver linings is higher rates help savers. So you had your money in the bank at 0. Well, now it's going to earn 0 plus maybe 25, 50, or 1% more. So it's actually a benefit for savers that has been really tough for a long time. Now, higher interest rates also reduce bond returns, at least in the short term. So as rates are rising, which we saw last year, bond prices tend to fall as interest rates rise. So we expect bonds to be have a hard time probably this year. And we do expect more stock market volatility. Now, that shouldn't be a surprise. We saw it in January. We've seen some more this month. And as the Fed starts to raise rates, we know historically for sure that that's a time when markets tend to be more volatile. The last 24 months, we haven't seen volatility. It's been absent, and that's actually unusual. It's much more usual or normal to have a correction at least once a year of 10%. So we've gotten spoiled a little bit. So can we churn and not burn? Can we wring out some of the speculative excesses in the market without really, damaging the overall market too much? And that's one of the conjectures that I think we can actually. This is some of the headline stocks that show where they are from their recent highs. Peloton down 78%. AMC Theaters and GameStop, as some people call these meme stocks, down 70, 60%. Arc Innovation, Kathy Wood's kind of famous fund, down 50%. Netflix, one of the FANG stocks, down 43%. Meta, Facebook, down 43%. I mean, these are painful. Bitcoin, highly speculative area, down almost over a third. Tesla off 30%, was just added to the S&P 500 last year. Biotech stocks off quite a bit, but the S&P off about 8% or so. So I think, there is a possibility that we can wring out some of the speculative excesses in the market without severely damaging the overall market. Let's look at it in terms of valuation. So if we look back, valuations were high back in 2000. This is the dot-com boom and bust. This is the great financial crisis peak, but it's not because valuation was so high, it's because earnings just dried up. So the denominator of the price earnings ratio went down a lot. So that's kind of an aberration. But here, very high valuation, very high price to earnings ratio relative to history, but it's moderated significantly as earnings grew so much last year. So now that denominator grew so much, and we've had some correction this year as well. So the orange line is looking forward on next year's earnings for the S&P 500, and it's well below the highs. It's still high-ish. It's still high-ish, I guess, relative to history, but nowhere near where it was earlier in the year. So again, bodes well, I think, for potentially being pretty constructive here. Now, rates are responding. I said sort of, because given the inflation headlines we've seen, rates haven't responded as much as you would think. The short side, the 2-year Treasury is the blue line at the bottom, has responded considerably, right? The 2-year, meaning people think that in a year, the 1-year rate's going to be a lot higher. And that's probably not a surprise, again, knowing where we are with inflation, and the Fed's been pretty clear that they're going to start raising rates. But the longer term bonds, here we have the 10-year Treasury in orange, the 30-year in gray. Yeah, I mean, they've responded. They're up a bit from certainly where the started last year, but not even to where the highs really on the 30, and 10's just above that now. So what is it saying? Well, the bond market's kind of telling us something. It's telling us, yeah, we're going to have to raise rates, but it's telling us it's not super concerned about inflation being something that's really long lasting. So what could possibly go wrong? Kyle, maybe you can help me with some of these.
Yeah, the people want to know, Mark, is there going to be a credit crunch?
Yeah, could the Fed put the brakes on so much that there's a credit crunch? And I think that's really unlikely. The money supply is just too ample today.
Okay, well, what about a recession? I mean, we've gone through a number of them. We just went through one recently. Are we going to have another one?
Yes, but I don't know when. And I don't think it's anytime soon, meaning like we've seen, the economy is really strong. The employment market is really strong. GDP is strong. I don't think a recession is something that's in the cards in the near term.
Bubbles bursting. So is the market going to crash?
Again, I don't think that's a high likelihood, given again economic strength, the underlying economic strength, and that we've had some of these mini bubbles bursting already. We've taken out some of that speculative excess, and valuations are moderating.
I was just looking earlier today and into this last week, getting ready for the presentation, and noticed oil spiked up quite significantly.
Yeah, I mean the oil price spike. I said unlikely only because it's already spiked, right? I mean, it's already high. The Fed doesn't really control that. Of course, if they were to really put the brakes on and crush the economy, which again is a balancing act, but I don't think they have any direct impact on oil prices. And one of the things that happens with oil prices is that over time, they're somewhat self-correcting. As prices get too high, demand is diminished. So I do think it will somewhat self-correct. There are some very specific things that have taken place in certain markets, like the oil market, that have created some of these imbalances, like we saw in the supply chain. We talked about shipping. I think we're seeing some of the same things here with lower investment rates in the oil fields, and some other technical issues that have created problems in the oil markets. Obviously, one that's on the headlines now too is Ukraine, and we'll talk about that.
Well, what about spiraling wage prices?
Yeah, I said unlikely. I don't think we're going to have a wage price spiral like the 1970s kind of situation. I do think wages are going to stay firm, and we saw the supply demand imbalance in the labor market, and I think that isn't going to go away soon. So I do think we'll still continue to see wages stay well bid. But I do think companies are investing really heavily in productivity, and that means software and other ways to increase productivity from their current staffs and to try to do more with less. But I don't think, again, this is something that will be out of control, but will probably stay firm for a period of time.
Speaking of a couple other things that could go wrong, the Russia-Ukraine situation, it just feels like it's changing every day.
Yeah, that one's hard to kind of handicap exactly what's going on there. But certainly the impact is greatest in Europe and on gas and oil prices.
And the Fed overreaction, what if the Fed raises rates too much? What happens then?
Yeah, that's a risk. I mean, I think there's political pressure to some extent, as well as just pressure by citizens to have the Fed help keep inflation under control. Of course, they have to weigh how much they do and how quickly with the impact on the economy, and certainly they don't want to try to create a recession. I think it's important to realize that when the Fed acts, particularly with interest rates, but with QE to some extent too, there are significant lags, right? It's not like they pull the lever, it just changes. It takes 6 to 12 months for these effects to work their way through the economy. So I think we have to be patient with that. The Fed has an out right now too. They can always blame it on inflation. Inflation was so high, we did what we thought was right. I think it is a risk. So what could go right? Well, a lot, actually. I think long-term trends are really intact. Software undergoing a major transformation to the cloud. Companies like Microsoft, especially their Azure, Amazon Web Services, these are really large companies that are growing at 30-40% a year, and new companies to the cloud like Snowflake. Tremendous growth, and even the old standards now, which are kind of new, like a software as a service in general, growing over 10% a year. Healthcare innovation, clearly still opportunities here. We saw what happened on the vaccine front, but I saw this headline the other day that I just thought was amazing. T-cell immunotherapy tied to 10-year remission in two leukemia patients. So definitely things happening on the healthcare innovation side. Cellular innovation, roll out of 5G. We've heard about 5G. I don't know a ton about 5G, but I know we are all going to know a lot about 5G shortly, because our phones are going to be faster, and we can watch movies faster, and we can text each other faster, and we can do everything faster. So that is going to be a thing that definitely permeates our lives. The semiconductor revolution, still going strong. there is a semiconductor shortage that will be taken care of probably in the next 24 months, but not tomorrow. Companies are building more facilities to fabricate semiconductors, but it takes time to build these plants. But semiconductor revolution is well underway. The Internet of Everything, there's chips in everything we own. It's in our refrigerator that talks to our phone, that talks to the front door, that is everywhere. It's in our phones, appliances, it's on our wrists. So this isn't going away anytime soon. Digital entertainment. Some of us that are a little bit older might have kids that play games. And actually today, we just saw NVIDIA report earnings. This is one of the largest companies, reporting 60% growth in their market, in the gaming market in particular. I think that we don't even understand all of the pieces of that as well as probably our kids do. I know Fortnite is a really popular game. This game is free. It's a free game. Generates, I think, over $5 billion a year in a free game. Okay, because they sell things inside the game and people buy them. And it's just, the incredible, I think, innovation in entertainment that is still really going strong. Streaming, of course, we're watching our Netflix and we're watching Hulu and all these things online, Disney Plus. A lot of opportunity there. EV and autonomous vehicles, of course, Tesla, the headline company there, but we know they're rolling out at Ford, they're rolling out at GM, they're rolling out everywhere. You've probably seen them on the road, you don't even know it, for some of the cars that are already in the space, but it's really an early part of a revolution in electric vehicles. And finally, renewable energy. I mean, we are still at the early stages of renewable energy. Some companies like Xcel Energy in particular are actually advertising they're trying to get to 50% renewable energy in a number of years. And I think this is just an indicator of some of the really interesting long-term trends that I think are really positive for markets over time.
Okay, everyone, like I mentioned at the beginning of the presentation, we want to hear from you. We are utilizing Slido. You'll see there's a QR code on your screen. You can take a picture of it with your phone, or you can go to slido.com and enter the passcode Affiance and vote on the topic we talk about next. We have a deep dive into rate hike history, housing markets, role of politics with it being a midterm election, some tempered return expectations in the Ukraine crisis. So go on there and vote. Okay, we already got some coming in. So while everyone's voting, Marc, while you're putting everything together, what did you find most surprising to you when you were getting the presentation to put together?
That's a good question, Kyle. I guess a couple of things. One was definitely the COVID waves. Seeing the magnitude of those and thinking back to what we thought early on, and then sort of the next wave, and wow, look at that, and it's done, and then wait, no, there's another one. That was, I think, really interesting. And then I also think that the labor market and some of the things going on in the labor market were definitely interesting, and seeing where those lines are of supply and demand for jobs and workers, I thought was pretty fascinating. Now, can we vote? We can vote ourselves too, right? We can say what we want to go to.
I mean, you are in the driver's seat, so. We'll give you guys a couple more minutes here to pick your topics, but so far we got about 24 people. It's an active poll. It's pretty cool software that we're using here.
If you go to slido.com, just type in Affiance, right?
Yep, that's all you got to do. Or scan the QR code. QR codes are crazy. Did you see the Super Bowl ad with the QR code that was just floating around? I gotta ask, did you actually scan the QR code to figure out what it was all about?
I wasn't able to do that at that time.
It was such a long commercial that I just was like, I gotta know. I'm almost positive it's a crypto commercial, but I gotta know.
Are you getting these down?
Yep. All right. Looks like it's still moving along, but I think we have a pretty good idea of the order we're going to go in. So Mark, it's the overwhelming majority here want to hear more about the role of politics, especially with it being a midterm election year.
Okay. So these are those same topics. And so role of politics, that's the top one, right?
Yep.
So does politics play a role? This is data going back to 1931, and it shows all of the years where there are midterm elections and all the other years. Pretty striking difference, right? That returns tend to be really muted in the first part of midterm election years. So the blue line here, the midterm election years, markets kind of bounce around up and down until the midterms in November. And then what happens? They start to move markedly higher. It's the old adage, markets don't like uncertainty. And midterms put some uncertainty into what's going to happen next, at least in Washington. Now, midterm years tend to have higher volatility. We talked a little bit about the volatility and how it's been unusually low until just the first part of this year. So we do expect volatility to be an issue going forward, meaning markets probably bounce around this year more than they have in the past. Very strong though after midterms in general. So the later part of the year, I would say after those midterm elections would be a time when markets likely are stronger. And of course, we know this is an unusual year as well. The Fed saying we're going to start to raise interest rates, probably causing some more volatility in the early part of the year as we see where inflation pans out and where the Fed actually ends up. How many times will they raise rates and how far and how much? Some of that will be answered as we get through to that later part of the year.
So, Mark, the next one up was the Russia-Ukraine situation. I know you and I have had some late night conversations talking through it, trying to figure out what's going on. And well, what do we have to know more about there?
Well, the Ukraine crisis is very difficult. I don't know if the history, they have 350 plus years of history together. Of course, it left the Soviet Union in 1991 and has had many different leaders over time. It's generally been mostly Russia focused, but has definitely moved more recently to be more independent and sort of more attached to the European Union side of the map. And that's really one of the problems, right? Moscow kind of wants control over this area, whether it's direct or indirect. And certainly it's now looking like it's wanted to take more direct control. I think, or I hope, all-out military conflict will be avoided. It's really unlikely Ukraine's going to join NATO. That was something that was brought up as, hey, we can't have Ukraine in NATO. That's next door to us. And I don't think that's, I think it's more of a red herring than something that's really on the table. I don't think the full-scale invasion really serves their geostrategic interests. Now, that doesn't mean they're not going to do it, but I don't think it's the best solution. Certainly, negotiating would be a better way out. I think on the sanction side, Russia's really well positioned to last this out. It's not vulnerable to external shocks, including sanctions. They have significant reserves, over 36% of their GDP. So kind of, waving the saber at them, I don't know how effective that is per se. Russia and Ukraine account for almost 30% of global wheat exports. So if there were a big war here, disruption, that could impact food, particularly in Europe and the East. And Russia supplies about a third of European natural gas consumption. That's a lot. And so there's definitely concern that could be disrupted. And that's one of the reasons, oil and gas prices are high, because there is some fear that there could be disruption in supply. So, net, I can't say what's going to happen here. We don't know. Obviously, nobody does. Is there a risk? Yes. But the other thing to keep in mind is that there have been major geopolitical risks through history. And if you look through history, in all those cases, yes, there is a short-term concern. Markets respond, right? Markets will go down a bit in the short term if there were to be a conflict, but they tend to be short-lived. and markets tend to bounce back pretty quickly. So I guess that's maybe the silver lining in this story.
Okay, switching gears a little bit, housing. So personally, I bought and sold a house over this last year, and I can tell you the housing market is crazy. So what can you tell us about that?
Well, what you saw is represented right here. So the blue line shows US house prices year over year, and you can see the spike in 2021 coming off just a little bit now. And interestingly, the orange line though is inventory. So again, a classic supply and demand issue. Inventory has been declining since the 08-09 great financial crisis. Now, prices for homes we know went up a bunch there, really crashed, and have come back strongly. But we're still in this situation where inventory is very low, and that has driven prices up. Again, the stimulus that took place, in addition to strong markets, people have been pretty flush with money. And what else has driven this? Low mortgage rates. Yes, mortgage rates have started to move up a little bit because we know, again, Fed's going to raise rates. We saw the 10-year rates moving up. But if you look at history, you know, we're complaining that there's a 3-4% mortgage rate. But if you look back 20 years, you know, our parents were paying 7-8%. Our grandparents were paying 12, maybe 15%. So we're kind of spoiled, right? Being down here at this 2 1/8, 3% range. But this is, again, one of the drivers because affordability has been so high. So the combination of affordability, all the stimulus, strong markets have really driven, and of course, you know, the mobility factor, right? People now with Zoom and kind of can be anywhere. All these things come to play along with that shortage of inventory that's created this situation. So I guess, you know, there's the explanatory variables, if you will, but in real life, I don't see this changing significantly. Higher mortgage rates when the Fed starts to raise here and rates move higher will dampen some demand, but it's going to take some time for this supply demand imbalance to work itself out.
We've talked a lot about investments and everything. So what are tempered return expectations? What should we expect?
Well, not everybody may know this, but the S&P gained 100% in the last 3 years. 100% in 3 years. A very unusual but welcome event that cannot be forecasted ever, right? We would never, ever, ever say, well, in 3 years, you're going to double your money. But that's what happened. And it's only happened 5 times since 1926. The most recent in recent history is 1998. You have to go all the way back to 1956 to find another period where markets were up 100% or more in 3 years. Now, interestingly, what happened in the next year? Well, in some of the cases, the market was still up the next year. Some of the cases, it was down a little bit. We can't say for sure what happens here. I mean, we're constructive. We think we can still have a positive year this year. But being up 100% in 3 years, you know, I might take that 8 or 10% down 1 year to do 100% in 3 years. So pretty amazing. If we look at it over a 10-year period, this is a global portfolio, the all cap world index and the bond index combined in allocations of 100% stocks to 100% bonds. So a 60-40 stock bond moderate portfolio over 10 years returned 126%, 8.5%. Pretty good for a moderate portfolio, right? Where the long-term return to just straight S&P 500 stocks is 10% over the last 96 years. So pretty close to that, even at that more moderate allocation. So it's been a really terrific 10 years for investors. So where are expectations looking forward? Well, if we look at different forecasters, and you can see the list, Vanguard, Fiducian, BlackRock, GMO, JP Morgan, Invesco, a whole bunch of people. We get all their forecasts, we put them all together, and say, what do people kind of think about where returns are going to be? Now, here's that same 60-40 portfolio mix. Here's the high average, a little over 5%. Here's the low, a little bit negative over the next 10 years. Don't think that's likely. But somewhere in the middle is 3.25%. Now, relative to that 8.6, really low. Now, forecasters tend to be overly conservative in general. So I would say this is, a low end. But to be fair, 8.6% has been a fabulous 10 years. If we got 5-ish, maybe a little more than half, just as an expectation going forward, I think that might be a ballpark kind of number.
Well, we've covered a lot of great information, but I think it's a good time to let everyone know kind of what our expectations or recommendations are for this coming year.
Well, we think the Fed action is justified. They said they're going to move in March. We know the economy doesn't need the continued stimulus that it has right now with zero rates and quantitative easing going on. And they need to normalize monetary policy to reload for the next stimulus event. I think inflation is largely self-correcting in time. The Fed will not need to go too far. Some of these things are going to work themselves out, like some of the supply chain issues. And I think that, if we could be patient long enough, we'd probably see inflation come down by itself. I'm not sure we're going to have that luxury exactly. So the Fed may have to do more in the near term. The stock market is going to gyrate with strong but more normal earnings growth. I think earnings growth around 10% for the S&P 500 is reasonable, given the strength that we've seen and still strong consumer and overall GDP, offset by some valuation headwinds in the near term, meaning when rates rise, we do see PE ratios compressed. Now, we've already seen some of that, but I do think we'll see some more. Net, I believe corporate earnings growth will offset those valuation headwinds and will still be constructive over this rate cycle. I think bonds are going to be challenged to earn their coupon at best, which isn't a lot, right? So if bonds earn 2%, that would be great. 3%, that would be great. But with rates rising, I think they're going to stay under pressure. I think stock market investors will be rewarded over the next decade, but to expect lower average returns than the past decade, which was really exceptional. So our recommendations, don't try to time the market. Nobody can do it accurately. We look at things to make adjustments around the edges, but we're certainly not market timers to say get in or get out. We can't do that. Stick to your financial plan and stress test your plan as needed. Go ahead and try looking at higher rates of return, lower rates of return, higher inflation, and see if your plan is robust to some of the stresses that might happen. Feel free to ask your financial advisor for help. Maintain a disciplined investment approach. In our investment committee, we say we are not bullish, we are not bearish, we are process, right? We're not making market calls, but we take a process to evaluate markets and make changes in our portfolios based on what we expect in the markets. We have made changes to portfolios based on market conditions. Many of you have seen that. Back in January, we made changes to particularly the bond side of the portfolio, adding some floating rate bonds as well as some hedge funds to those areas where we think that they're going to have better returns than bonds. And we also made some changes to stocks, moving a little more toward value and a little more toward international in some of our Sage ESG portfolios. We know we can't control the markets, but we can control our actions. So clients rely on us for providing a disciplined approach to investment strategy, investment process, and holistic financial planning. Our investment committee meets once a month to review markets, to make sure we're close to what's going on, making changes as we see necessary, and looking at that broader context of your portfolio within your financial plan. Feel free to call on us if you have questions. Call your financial advisor. Feel free to contact me. I'd be happy to answer any questions you may have going forward.
On behalf of the entire Affiance Financial team, we want to thank everyone for attending the 2022 market forecast presentation.
Thanks,
As
Kyle.
a reminder, thanks, Mark. As a reminder, the recording of this presentation will be available and posted on our blog. Until next time, see ya.
Thank you.